What are we in store for here? I mean, we had, in some ways, like 7 years of feast, and now we have 7 years of famine.
The Federal Reserve is going to sell, or have run off the balance sheet, about 5% of GDP. That's 10% of GDP. Okay, who's going to buy the bonds? Who's going to buy that? Now they don't want to buy the bonds. We've had, pension funds, others, they don't want to buy that bonds. Foreigners don't want to buy the bonds. So then the way that works is interest rates have got to go up to a level that constricts private credit demand. And when that happens, then there's less spending. That's the mechanics. So there's that trade-off. And I think we're going to be in an environment in which they're trying to navigate these two difficult. You don't want too much inflation and you don't want too weak an economy. And so they're trying to navigate that, which will be probably something like the 70s. And that's all happening in the context of the political conflict, which is very important, and the international conflict. Because the international conflict has bearing on things like inflation, supply lines, and all of that.
You just said something briefly, something like the 70s. And my question is, what are we in store for here? I mean, we had, in some ways, like 7 years of feast, and now we have 7 years of famine. Is that what we're looking at right now in order to get inflation back in line? Because thus far, the Fed is being pretty convincing to a lot of people. They really mean what they say.
Yes, and the consequences, just everybody, is, do you understand what that means? That's great. They mean what they say. What they've done is they produced this giant lurch forward. And now, yes, they will raise interest rates to the point that there's enough economic pain and financial market pain to deal with that.
And it'll be real pain, no question about it, and not least in the form of unemployment, in all likelihood, that we're going to have. At the same point, from your point of view, your perspective on history, despite the pain, is it the right thing to do? Because in the long run, even the people who make less are hurt by inflation more than anybody else is.
The key, of course, is to try to get the balance as best as we can. I call it a beautiful deleveraging. You need a beautiful deleveraging. How do, in history, debts decline relative to incomes? So you could go back and see the mechanics of that. And the way that happens is a mix of some amount of restructuring debts, and that is a deflationary force because one man's debts are another man's assets. And so some amount of restructuring is a deflationary force. You take buying power away from others. And then some form of debt monetization. And to get the stimulation, they tried to get the middle ground. Because of the size of the issues we're dealing with, it's not something that we're used to in terms of its magnitude, I think. And then if we take the internal conflict factor, I think we have to look at all three because they play a role. Traditionally, those three things are the perfect storm, right? They all affect each other. If you have a bad economic situation, as you said, it affects one group of people and it hurts them, then you have an internal political conflict, right? The left and the right, the rich and the poor, and so on. And then that affects things, and vice versa. And then, of course, the external conflict, the cost of the external conflict. Like, for example, it's estimated that so far the cost of Ukraine war to NATO is something like $8 trillion to rebuild. Are we going to rebuild? Are they going to rebuild? They ask the NATO countries like they ask the European countries. Are you going to put in? Well, they're broke, and they're going to put in. Then if you look at the cost of climate change is approximately $10 trillion a year. If you look at the cost of building infrastructure, if you look at all of those costs and you add up those costs, it's not like we're going to stop the spending. So you have to achieve that financial balance in some kind of a way. Right now, governments are like people, meaning when you spend, you think the basic economics works the same. The only difference is they get to print money. When you spend, you think, how much money do I have to spend? And then wherefore, what do I prioritize it on? Governor Lamont has that challenge. We all have that challenge, not the federal government. So what happens is the government says, what do we need to spend money on? And they go spend the money. And we don't have that balance. That issue is a big fundamental issue, particularly when we have populism on both sides.
Given where the United States is in the cycle, one of the things you talk about in your book is reserve currencies. And when you become dominant, you get to have the reserve currency, like the British pound before US dollar now. Given where we are, why is the US dollar so strong? Is it too strong?
I think it's important for you and everybody to understand that you shouldn't look at the value of the dollar in relationship to other currencies as much. They're all bad currencies. So we can get into why Europe is a bad currency and why the yen is a bad currency. They're all bad currencies. And they are all depreciating in buying power, just like the 30s, just like the 70s. They all depreciate in relationship to what they can buy. Currency is money. But when we look at one in relationship to another, we may not pay attention to that. So that's our existing set of circumstances. Okay, the answer is the euro? Are you kidding me? I mean, we can go on about Europe's situation. Wow. Oh my God. And then, okay, what are they doing in the end? They're just printing the money, whatever it is. And so the question is, what is a storehold of wealth? Money is a medium of exchange or a storehold of wealth. And it's not a good storehold of wealth when the interest rate you're receiving is much less than the inflation rate. So that's what you're seeing happen.
Given what you're saying about the world in terms of inflation and the reduction in the value of the currencies around the world, where is the right storehold of wealth? I mean, is it gold? Is it Bitcoin? Where do you go to defend yourself against inflation?
This is the question of our time. We will, over the next 10 years, certainly, I think, be trying to find the answer of what is the storehold of wealth, because usually it's a money and then a debt instrument in holding that money. But as that goes down, then there is the question of what it is. What is that currency and storehold of wealth? So we're in that place. It's always handy to be the thing that is your buying power. You're going to see it more in inflation hedge assets. So like if you're thinking about a bond, it's better to think about an inflation hedge bond than to think about TIPS or inflation hedge assets along those lines. And I think that you're going to see then the parts of the economy. So like I think basically, if I was saving, what would I want to save in? I'd like to save in the things I know that I'm going to need. So I would like to save in my residence, my house. I would like to save, if I could, pay forward my kids' education, pay forward the food or the health care that I can, and so on. I would want to save in those things to buy forward the things I need, most fundamentally. I think if we start to think that way, not only in terms of the investment, but what are even the meat and potatoes type of businesses that are doing that? And then also, I think that you have to think geographically. Where is best in the world? Say that best in the world are countries in which they're earning more than they're spending and their balance sheet have more assets and liabilities on them, that they're civil with each other and not in conflict, and that they're not in risk of an international war. It's basically those fundamentals. And then I would say we are in an intellectual revolution, that our capacity to invent and think and use technologies to help us think has never been greater than before. And so those revolutionary type of technologies, when they're cutting edge, I think that those are good investments. And I think then what you have to do is also diversify. Because the thing I learned is it's all return in relation to risk. Everybody looks at how much return you make, but it only takes one time to knock you out. Bridgewater's been doing this 47 years and we survived. You have to survive first. It only takes one time to knock you out of the game. And so you should never lose more than X amount of money that you can't recover, because you lose 50%, it takes 100% to get back. Diversification, knowing how to do that well, allows you to reduce your risk by up to 80% without reducing your return. So I think that those would be the approaches that I would emphasize in this environment. And I would not, generally speaking, I don't think we're going to have a sustainable interest rate that is going to be a real adequate interest rate. And so I would stay away from debt issue. Now, the interest rates went from ridiculously stupid interest rates, and they're coming into an area that still I think is too low, but it's not as ridiculous as it was before. They have to get really, so when you play with that game, if you want me to just do it, I'll give you my thought real quick. Okay, what would be the equilibrium interest rate for the equilibrium inflation rate? Okay, we're going to have probably, I would estimate, somewhere between a structural employment inflation rate, maybe in the vicinity of between 4 and 5%. In a highly uncertain environment, you can't even be sure of that, but let's say that. That means then what is the real bond yield? Okay, so you have to go to that. We now have about a 1.5% real bond yield. You still have a 1%. So you have to have the bond yield give you something. I don't know what that is, but that brings it above 4.5% to some other number. And you have to have relatively tight money, which means that you have a fairly flat yield curve. So I don't know whether that's 4.5% or the economy could not take an interest rate much higher than that before it's going to be negative.
Found this video insightful? Hit subscribe, turn the bell on, smash that thumbs up, and dive into the links in the description below. Join our vibrant community to ensure you never miss a video. Your generous support fuels our passion. Thank you for watching. We love you.